2011, China had been called uninvestable. 2015, after this massive stock crash, China had been called uninvestable. And in hindsight, those moments of uninvestability were great times to set up for compounders over the coming years. Innovation is very much alive and kicking in China, and that gap between the US and China on AI development is one that can close over time. These two Chinas, the hopeful China that you're talking about and that gloomy China that you're referencing, they coexist. And that is precisely what's exciting about investing in China.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a massive welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are speaking to one of the speakers who is coming to Australia for the Hearts and Minds Conference.
Yes.
This time of year, the conference is in November every year here in Australia, and it is always a great time for us to speak to some fascinating investors from around the world, and this time is no different. Today we're speaking to Eric Wong. He's the founder of Stillpoint Investments, and he's joining us all the way from New York.
Yes. So Eric is, as Ren said, he's going to be here live in Sydney, but in our interview today, we are going deep on all things China because that is where Eric has been spending the last over 2 decades, I would say, focusing his attention on the investment opportunities that are now emerging in China. We're talking all the tech companies, AI infrastructure, you name it. Eric is looking at it.
Yeah, Labubus.
Labubus,
Yeah.
yes.
China is in a fascinating space. You know, for a lot of investors, it's just simply uninvestable. But then for a lot of investors that are China curious, the last few years has made people pretty nervous. We saw a big collapse in the COVID years, partly driven by the slow-moving housing crisis that was sparked by Evergrande. We've also seen it in the, the slow reopening from COVID, and equity markets have been down. But this year we've seen a turnaround. We've seen a sharp turnaround in some stocks. It'd be nice if you owned Alibaba.
Yes.
But I guess sentiment is starting to change. And so we wanted to speak to Eric about what he's seeing on the ground and what he's hearing from his investors about China as an opportunity. And perhaps unsurprisingly, he sees it as a big opportunity.
Big opportunity. Well, before we jump into it, you can head to the Sohn Hearts and Minds website. We'll put a link in the show notes if you'd like to grab a ticket to head to the conference. It is Friday, 14th of November. Investors from all around the world will be either dialing in or be there in person to give their best stock ideas for the next 12 months, including Eric.
All in aid of medical research. The structure of Sohn Hearts and Minds, the conference and the listed investment company with the ticker HM1 is that they donate the management fee they would take to medical research. Yep. It's been running for 10 years in Australia. They've donated, I think, over $80 million to medical research. So it's a great cause. Whether or not you're going to the conference, it's great to support them and to get around some of the medical research that's changing lives in Australia. So we're happy to do our small part by talking about it, and we're pretty lucky that our small part means interviewing some of the best investors in the world.
Absolutely. Well, let's jump into it. Here's our interview with Eric Wong. Well, Eric, welcome to Equity Mates.
Thank you, Bryce. Excited to be here.
So we want to start with a bit of an introduction to who you are. You're joining us all the way from New York, and you will be soon here in Australia as part of the Sohn Hearts and Minds conference. You spent a lot of your early career learning from some of America's leading hedge fund managers. So what were some of the most important lessons, or what was the most important lesson that you learned during that period that shapes how you invest today?
Well, again, thank you for having me here. I'm really excited. I'm really looking forward to Hearts and Minds in Sydney in a few weeks. But you're correct. I had the opportunity and really a blessing to learn from people on the street that I never thought growing up that I'd have a chance to learn from. One of those being specifically John Griffin, who founded Blue Ridge Capital, where I worked for more than a decade. As background, John Griffin had previously been president at Tiger Management with Julian Robertson before forging his own path with Blue Ridge Capital. And for me, the impact that John Griffin had on me was multifaceted. I think everything from learning how to build an information network to learning how to have a very healthy dose of skepticism in looking at the world. Those are things that I learned from John. When I think about something that really has stuck with me, or perhaps the most important thing that he gave me, it was really, I think, more like a mindset. John has a very, I would say, wonderful sense of irreverence, and it's something that he teased me for never having enough of. I mean, the sense of irreverence, more specifically, what I mean by that is he has a complete disregard for hierarchy or convention as it relates to the search for truth. And so he would always tell me I didn't have enough of this spirit of irreverence. And so much so that I actually taped the word irreverence on the top of my computer screen as a reminder.
nice.
But, this really helped me in the sense that when you come across an industry, quote unquote, expert, you really take that person's point of view at face value for what they're saying, and not necessarily because of the perch that they have or the experience that they've had. And that type of separation between the content versus where it's coming from was really helpful for me in terms of assessing how applicable someone's perspective was to my analysis. And beyond that, the irreverence also was really around challenging John. He really wanted me to challenge him more and to put away this hierarchy of portfolio manager, investment analyst. And so that type of spirit is something that really has stuck with me and is something that I continue to work on. And so that was, I think, when I think back to my experience with him, the biggest gift of all.
I love that. And I think that's going to be a theme that flows through this episode, that idea of challenging conventional wisdom and, the ideas that certain people in hierarchies may hold, because you have focused your career, your investing career, on a part of the world that many consider uninvestable, and that is China. You've been investing in that country for 20 plus years. You spend a third of your time there. What initially drew you to the Chinese market and the Chinese opportunity, and what keeps drawing you back there, despite, conventional wisdom that it may, in some respects, be uninvestable?
Well, I first started my career in China's financial markets, I guess, almost a quarter century ago, right after university. I had studied the large changes that were taking place and the transformations that China's economy was going through in the late 90s and the early 2000s. And suddenly, after university, I found myself at the front lines of that. I was helping to restructure large state-owned enterprises with an investment bank, and helping to bring these large businesses to the global stage through public markets, IPOs. And I think what fascinated me about China then, as it continues to today, is simply that China in many ways defies simplicity. It is a place where the more you know about it, the less you know about it, or the less you feel like you know about it, because of how vast and complex it is. And just as an example, the regional disparities of China are just extremely stark. So you can be in Shanghai, which I think everyone in the world is familiar with or has come across, this large global metropolis with a population of 25 million. And then you could also be in a completely barren place, in western parts of China, Gansu province, which is, I guess, physically the size of like a whole European country, also with a population of 25 million. And I think both of these places are all parts of China. And so I think when people say that China is uninvestable, I tend to think that is interesting, because these sweeping generalizations can sometimes oversimplify narratives. And for us investors, I think those oversimplifications can sometimes be pockets of opportunity, because there can be misconceptions that lie therein. And so that's the fun part for us. And that's what drew me in, because of how complex it was. And how complex it continues to be today, and perhaps is becoming even more complex over time.
So you started Stillpoint in 2022, leaving a pretty prestigious managing director role at another firm. 2022, arguably one of the more challenging times for Chinese equities in at least our sort of living memory. What was it about that moment in time that really gave you the conviction to start your own fund?
That's a great question. When we launched with outside capital at Stillpoint, with outside capital in 2022, China was already being called uninvestable. And on my watch, I felt like I'd seen this movie before, because China had been called uninvestable through many cycles over my career. So 2011, China had been called uninvestable. 2015, after this massive stock crash, China had been called uninvestable. And in hindsight, those moments of uninvestability were great times to set up for compounders over the coming years. And so that was, in ways, what gave me what you're asking about, the confidence to launch during a moment when China was already in such a controversial moment. Because I think, as we mentioned earlier, China is vast and has so many different facets to it, right? And I think views and perspectives on China can easily swing between extremes. It can really overcorrect on the downside. It can really overstretch on optimism as well. And so I think it really never stays in these extremes forever, right? But of course, to your point and to your question, I think this most recent period of uninvestability lasted much longer than I ever anticipated, right? I think the fumbled reopening after COVID zero really left a lot of people, investors, people in China, people outside of China, wanting for more. And so I think that's, in many ways, what led to this prolonged period of, and we can talk about what that means, the quote unquote uninvestability of China. But I think, in our industry, patience is required, and cycles can change. And so what we've seen this year so far in 2025 is that the Hong Kong markets are up, 30+%, twice as much as the S&P. And so I think that patience, in ways, has earned a gradual path to an outcome that maybe shows us that that tide or that cycle may be turning at this point. So I think, we've been patient through the cycle, and it's certainly lasted longer than we anticipated. But this swinging between these extremes of optimism and pessimism have always taken place with respect to China.
Mm. Well, Eric, let's dig in and let's go a step further, because so far, I guess we've challenged the conventional wisdom that China is uninvestable, but that isn't your thesis. Your thesis is, and I think you've written this, that China may no longer be the risk; it may be the opportunity. It's not just that it's not uninvestable; it's just that there is a big opportunity there that you don't want to miss. So we want to dig into it, but let's start at a high level. Walk us through why China is the opportunity.
You're asking me to describe my irreverence, perhaps, right? I think my perspective on China being the opportunity really has been reframed over the last, call it 12 months or so. And there have been a few events that I think have allowed investors and people around the world to reframe how they think about China. I think the first thing is the DeepSeek awakening that took place in January of 2025. I think for a long while, people thought that China's AI development had fallen off the train, fallen well behind what was happening in the United States. And I think what happened with DeepSeek earlier this year in January was that China revealed that it had a very strong, and it has a very strong hand as it relates to AI development. Innovation is very much alive and kicking in China. And that gap between the US and China on AI development is one that can close over time. And so I think that moment reframed the concept and the perception of how innovative China is in this new stage of technological innovation. So that's one thing that's changed over the last 12 months. I think another event that took place over the last 12 months is the policy pivot that we saw take place in at the end of September and early October of 2024. So what happened then was that the Chinese government came out and was very clear in telegraphing what it would and wouldn't do to stimulate the economy. So prior to this moment, especially after the release of zero COVID at the end of 2022, I think investors around the world and people in general in China were expecting the government to step in and unleash a gargantuan stimulus package to boost the economy. And that simply didn't happen over the course of those few years from 2022 all the way until 2024. And in 2024, at the end of 2024, the government came out and basically telegraphed very clearly that they would stimulate on an incremental and consistent basis to stabilize the economy rather than throw some bazooka stimulus that they had done prior in 2008. And so I think this alignment between policy intention and market expectations is another shift that's taken place over the last 12 months that has allowed investors to reframe the opportunity in China. And I think I'll list one last thing that's happened over the last 12 months, and this has surprised me, is that there has been a reemergence of risk appetite from onshore investors in China, so domestic investors. And my view has always been that any recovery in China's equity markets would have to be led by onshore investors, not foreign investors. And what we've seen starting from, call it end of 2024, all the way throughout 2025, and this is most kind of prominently displayed through the fund flows coming from mainland China into Hong Kong, we call them southbound flows, have been very strong and very consistent throughout 2025. So those numbers, I think year to date this year, are like 150 billion US dollars for the first 9 or 10 months of the year. And for all of 2024 was only about 100 billion US dollars. So we've already surpassed by 50% that amount for 2024. And so that risk appetite is something that has also changed over the last 12 months. And that's a meaningful difference in enabling, I think, the stock market to be able to, I guess, reflect and reward businesses that are generating growth. And so I think that's another element that we are watching closely, but another change that's taken place over the last 12 months that I think has led me to share and write, as you point out, that I think China is now the opportunity.
So let's talk about the trade war, because I think a lot of people would be sitting here thinking that that's the big dark cloud that hangs over China at the moment. What is your view on it? Like, how do you think about, the uncertainty around US policy at the moment, Donald Trump flip-flopping between the level of tariffs that he's throwing on China? Does that make it look more investable or less investable for China? And I think if you can also touch on how China can withstand, or to what level China can withstand this trade war from America. Just your general thoughts on the trade war.
I think if we rewind the clock a little bit and think about why people had deemed China uninvestable in this most recent period, it had come down to, I think, policy volatility. If you recall the crackdown on after-school education and online tutoring that took place in 2021, that was very sudden. The COVID zero lockdowns and then the very sudden release of those COVID zero lockdowns, those were very much unexpected by the market and wreaked havoc on how people viewed policy stability in China. And so that's what led many people to believe that China, or label China uninvestable. Now, you're asking about the trade war in the United States policy. I think, you look at what's happening today in terms of policy volatility, and I would say that policy volatility is coming not from China necessarily, but from the United States, right? And this goes to the tariffs that you're asking about. I think, as it relates to the trade war, the tariffs can be on and then off and then on and then off again. I think these chip bans or industrial policy generally can change with a tweet or an executive order. And I think that type of policy volatility has emerged in the United States in recent months in ways that I think people used to criticize China for when I think at the height of its uninvestability and policy volatility. And so I think when I think about what's changed in terms of geopolitically the landscape over the last few months, I think Trump's policy has in many ways leveled the playing field in terms of expectations around policy volatility, and in many ways shown people that policy volatility isn't something that is uniquely Chinese. And so I think that's something that has reframed what uninvestability and China together might mean.
So, Eric, we've got one more question on, I guess, China generally, and then we want to get
Yeah.
into some specific themes and investment opportunities.
Sure.
As we were researching for this interview, we read a New York Times article that quoted you talking about, I guess, the dichotomy of China and how we think about China. On one hand, there is a hopeful China, and we sort of see these emergent companies that are taking on the world, DeepSeek, BYD, Huawei. And then on the other hand, we see conversations which are perhaps more a gloomy side of China. Unemployment, particularly youth unemployment, the ongoing housing crisis, questions around weak domestic consumption. How do you reconcile these two Chinas as an investor and try and find, I guess, the signal amongst what is a lot of noise?
Right. I mean, I think in many ways, these two Chinas, the hopeful China that you're talking about and the gloomy China that you're referencing, they coexist. And that is precisely what's exciting about investing in China, right? I think for us as fundamental equity investors, right, we can select what parts of the economy we want to have exposure to in our portfolio. And so we can invest in the parts of China that are building for the future, maybe some of the themes that you're talking about in terms of AI and technology breakthroughs, and maybe even some new consumption, right, despite the subdued consumption environment. And we can also avoid parts of the economy that are structurally challenged. And so for us as equity investors, I think we don't necessarily have to reconcile between these two versions or perceptions of China. And in fact, I think it's the in-between where the truth lies, and oftentimes where we think like the most exciting opportunities can be found.
So before we dig into some of your specific investments, I think let's start generally. Like when you look at your portfolio, what are the sectors that you're sort of really excited about and engaged in, and that sort of make up the large components of the portfolio?
When we think about the portfolio, some of the large thematics that are present there include AI and the meaningful investment that Chinese businesses are making in AI infrastructure onshore in China. So that's one thematic that's very present in our portfolio. A second thematic that's in our portfolio is around precision manufacturing. And these are businesses that are exporting goods that are being sold to other parts of the world, primarily the United States, Europe, South America, to help these places build out manufacturing capacity. And so we like this thematic because there is some degree of, we believe, misperception around them being roadkill for tariffs. But instead, our view is that they are beneficiaries of the reconfiguration of supply chains around the world. And so that's another thematic that is in our portfolio these days.
So with some of those technology-specific names and the AI story and data centers, a lot of people are really focused on the US restrictions on not just tariffs generally, but the restrictions on advanced technology sales to China, the cutting edge NVIDIA chips, but also things that go into the semiconductor supply chain like ASML's lithography machines. How do you think about these advanced technology restrictions and how do they affect your thesis when it comes to some of these technology names in China?
Got it. So just to take a step back, where we're invested in the AI data infrastructure space is primarily in the AI data centers that are providing the compute power for China's hyperscalers like ByteDance, Tencent, and Alibaba. And they're no different from the hyperscalers in the United States like Amazon, Meta, and Google that are expanding data centers globally, right? And these Chinese hyperscalers, I would say, are probably 12 to 18 months behind in their CapEx cycle and are unleashing this wave of CapEx to build out data centers. And where we're invested in is those data centers. And you ask about the restrictions and the technology restrictions that are coming into play between US and China on this geopolitical front, right? That they've been creating headlines all throughout this year. And we've been continued to be meaningfully exposed to these themes and this theme specifically throughout the year. And I would say when we think about those chip restrictions, like the NVIDIA chip restrictions being sold to Chinese businesses, we think about it like this. The hyperscalers need to build compute power. And as a result of that, they will need data centers. So it doesn't matter whether they're using NVIDIA chips, domestically produced chips, or a combination of those chips, right? They will still need that physical infrastructure to be built out. And so from our perspective, that demand and that underlying fundamental demand is where we spend our time researching to assess the stability and the strength of that demand. And our view is that it isn't necessarily impacted by these chip restrictions. Now, these stocks like the GDS and the VNets, they can be very volatile and very sensitive to these headlines. These headlines can cause meaningful moves in the underlying stock price, partly also because these stocks are very levered. But in our view, the volatility is something that we're willing to sit through because we have conviction in that underlying demand. And in many ways, we take advantage of that volatility because it can create noise and mispricings for us to be able to rethink about how we want to be exposed and how big and small the exposure needs to be in our portfolio. So in certain ways, we acknowledge those geopolitical tensions and the potential bottlenecks that they may create on the underlying development of that ecosystem. But I think where we choose to play is less sensitive to that back and forth, yet the stock prices tend to be sensitive to that back and forth. And for us, that creates an opportunity. So that's a little bit about how we've been thinking through that geopolitical tension, the restrictions, and how we remain exposed and excited about that thematic.
So, Eric, one thing we've been seeing a lot of recently is just a conversation around the demand for energy that all of this, compute power is going to require over the coming years, and perhaps there's just not enough energy to support the growth. China's obviously putting a lot of resources into making their energy mix pretty strong. You've got solar, they're putting a lot into nuclear and the like. How does that sort of play into your thesis around I guess the role that China will be able to play globally when it comes to data centers and AI infrastructure?
So I would say the bottleneck that hyperscalers in the United States and in other parts of the world are seeing in terms of energy bottlenecks and the anticipated energy bottlenecks is not something that we are seeing play out in China. As you point out, there's an abundance of energy sources, of all different types of energy sources that China has been building out capacity for. And as a result of that, that is not the bottleneck to building out the AI data centers in China. As it relates to how China's data centers contribute to compute power globally, I think that still remains to be seen and is a part of that geopolitical conversation as it relates to diffusion around the world of that compute power. And so I think our investment theses are not necessarily predicated on that per se, because I do think that that continues to be a question mark. But within China domestically, I think the energy bottleneck is not present in the same ways that we're seeing in other markets geographically.
Must be nice.
So, Eric, one last thing. Yeah, it must be nice. I saw some chart about the cost curve on China building nuclear and how their cost curve is going down while the US cost curve for building nuclear is going up per gigawatt hours. That must also be quite nice.
Yeah.
I mean, I would say that's happening across all industries, right? I think even as consumers, anything that you buy in China is a fraction of the price that you would buy it for in other parts of the world. So it's not just these power generators that are seeing the cost curve decline. It's across all sectors in many ways. And I think that deflationary environment is a good thing and a challenge at the same time, right? And so I think you say it must be good. I think that comes from a perspective of dealing with perhaps the potential cost inflation from bottlenecks and not enough supply. But on the other hand, sometimes that deflationary pressure can be reflective of other challenges as well in the Chinese context, right? So I think there are both ways, there are different ways to look at that general trend.
Well, I mean, can you expand on that? Because that is an interesting thought, and I think it would be good to unpack that further. Where costs are coming down across the Chinese economy as they're investing a lot in capacity and supply, and in sometimes excess capacity and supply. How does that change the economy, and how does that change your approach as an investor in that economy?
I think in certain respects, that cost curve coming down is the result of extreme competition that's taking place between Chinese businesses that are manufacturing goods, whatever goods you want to be talking about, right? And in certain respects, those costs are coming down and it's extremely competitive because demand is tepid and not as strong as some of these businesses might have anticipated when they put in the investments to build out that capacity. And so in certain ways, when you see that deflationary or those cost curves coming down, that trend taking place, it's reflective of just ruthless and very, very hard-nosed competition. But then at the same time, it can be also reflective of demand not being strong enough domestically to support that capacity. And so how does that impact our investment approach? I think when we think about the consumption environment in China and how we are exposed to it and how we want to play it, we are very selective about what parts of that consumption environment we want to invest in, right? And I think just because consumption has not been as strong as everyone anticipated doesn't mean that there aren't great businesses that are really capturing a lot of value and a lot of growth in that environment. And so in many ways, it's being much more selective about how you want to play the Chinese consumer. And so I know I'm answering your question indirectly, right? But I think, we have to take that broader context into account and then position ourselves and find where we think the best opportunities are, even if, generally speaking, consumption could be stronger than where it is today.
One last investment theme I want to ask you about is the pop cultural craze that is Labubus. So, we often think about the Chinese companies taking on the world in the tech side. You've got your BYDs, your Huawei's, your DeepSeek, and you don't think a lot of the cultural impact of China being exported to the world. But I think Labubu is certainly an example where it is starting to happen, and people who have invested in Mart are certainly enjoying that run. I saw, but I guess, in a Western context, we think about Labubus as the modern day Chinese version of the Beanie Baby of the 1990. But I saw recently on Bloomberg that you may have a slightly different opinion. You think the Labubus may be more than just a fad. So I'd love you to talk about that and use sort of Labubu as an example to talk about the growing Chinese cultural power being exported to the world.
Okay, well, now my kids are going to be really excited because I'm talking about Labubu with you. But I would say that for us, the story with Labubu was one, or Pop Mart generally was one that we, I guess, evolved with over time. I would say at the outset, we were quite concerned around the sustainability of how consistently the company could deliver this type of growth with IP like Labubu. And what we begin to notice over the course of time, and this is specifically within the domestic Chinese market, which is a much more mature market for Pop Mart's IP, is that the library of IP and the tail of IP that Pop Mart has is deep enough to offer other IP that have the opportunity to replace that momentum within its overall sales that Labubu once had. So just to give you a sense, the Labubu series, The Monsters, domestically within China this year is something like 25 to 30% of domestic sales in China, which means that you have 70 to 75% of their sales coming from completely other IP that has nothing to do with Labubu. And I think from an overseas perspective, yes, everyone thinks Pop Mart equals Labubu and Labubu equals Pop Mart. But if you go to a more mature market like onshore China, you'll see that Pop Mart equals Labubu and Dimu and Crybaby and the Stars, right? And so it's a lot of different IP that make up what they're doing in terms of sales in China. And so I think that's what leads us to have a view that there is a constructive way to look at what's happening with Pop Mart, and we observe what's happening over time. And we do see that diversification of revenue sources taking place within its onshore revenue. And we're observing what's happening offshore as well very closely. So I think for us, it continues to be something that we watch very closely. And I think the story could evolve over time, but that's how we see it for now. And I think it started with a very healthy dose of skepticism that the Labubu craze could not be replicated by other IP.
So, Eric, we want to turn to some of the risks that come with investing in China, and I guess the biggest risk that, as people say it, is I guess the authoritarian government. And we've seen often government priorities sort of prioritized over just companies' general functioning, the capitalist market. I guess the video game crackdown being one that you mentioned earlier, and that sort of being seen as a risk. I guess also the context we're talking in now. This week last week we saw the biggest military purge at the top of the military since 2017. 11 senior military officials were cleared out. You do just have this general authoritarian backdrop to some of these amazing companies emerging. How do you think about that as a risk when it comes to investing in individual companies in China?
So I would say that policy risk has always been a very important part of analyzing a company in China. To your point, the large role that the state government plays in the economy generally makes it such that it is essential to understand the policy landscape for any industry before we get involved looking at any company specifically. And so that's been something that has been a part of my time investing in China over the last couple of decades. So I would say that for us, when we think about navigating that, we lean on the networks that we've built over a long period of time across different sectors, across different geographies, the US and China, to give us a sense of where policy might be headed. So these are people who are working in industry, people who are at think tanks, or people who are academics, and they can in certain ways, help us think about similar problems from a different perspective so that we can get a sense for where that policy might land, right? And as a result of that, understand what the potential outcomes are and position ourselves accordingly. Now, that being said, to your point, and this is the way John Griffin would frame it, he would say that policy is a down card in the sense that you don't know what that card holds until it it gets turned over, right? And so that is oftentimes a challenge. But I think for us, leaning on those networks of uh, perspectives that we've built over the years can help us for specific companies or specific industries be able to assess at the very least what's at play, what the incentives are, and what's at stake. And so when we think about what the incentives are and what the larger kind of directional policy landscape might be, it can help us get a sense for where those potential outcomes might land. So it's a bit of a probability weighting exercise, is what I would call it.
So, Eric, property is still about 17% of China's GDP and remains in crisis. How much of a drag does the property situation sort of fall on your thesis? When do you think this gets resolved, if ever? how is it really playing on your mind?
So it is the property downturn is definitely a drag on the broader economy in China. I think there's really no sugarcoating that whatsoever. I think you mentioned it's now 17% of the overall economy. At its peak, I think property plus related sectors were over 30% contributors to overall GDP. And so even now, I saw in a recent analysis that in household wealth, property still comprises about 55% of overall household wealth, even after the price drops we've seen over the last, call it 3 to 4 years. And so I think that downturn definitely casts a shadow on consumer confidence, as well as the impulse to spend, right? And so I think that will take some time. I think it will take a couple more years to digest, right? And you say it might never be fully digested, but I think I think what we've seen come out of, and this goes back to what we were talking earlier about policy, the government has been very intent upon stabilizing what's happening. And we're not looking for a property price reflation per se, right? Because I think the government knows the challenges of having to manage that type of that property bubble and its reflation. So, but I think for us as investors, it goes back to choosing what parts of the economy we want to be exposed to, right? So we know that there is this deflation or this property bubble taking place or being popped, right? And in the downturn causing a drag on the broader or parts of the economy. But at the same time, and this goes back to that hopeful China that you were asking about earlier, I think there are elements in parts of the economy that we get very excited about with businesses that are benefiting from structural growth and can deliver earnings and cash flow. And so that's where we put our chips on the table, as it were.
So, Eric, as we wrap up today, I guess for people listening, what do you want to leave them with? You know, we started this conversation by talking about the general perception in some corners of the world that China may be uninvestable or isn't such an exciting investing opportunity. Hopefully, we've challenged some of those preconceived notions today. But for people, either individual investors or institutional investors listening and thinking about China, what's the lesson or the message you want to leave them with today?
That's a great question. I would say that the message isn't necessarily that they should have a blanket position on buying China per se, right? I think we've acknowledged there are two different Chinas at play. But I think it's important to acknowledge that there are two different Chinas at play, and one can be selective in where they want to be positioned as it relates the Chinese equity landscape, right? So for us, it goes back to choosing the stocks that we think can compound over the next, call it 3 to 5 years. And so for us, that is our overarching goal. And I think a lot of times the misperceptions around what China uniformly looks like can leave out or prevent people from seeing the exciting and the tremendous growth opportunities that are taking place within this landscape. And I think that at a time when the domestic investors are telling you with their own cash that they want to place money into the equity markets, and I'm sure they're being selective as well, right? They are the consumers that are living there, and they know what's hot and what's not, right? And so I think at a moment like this, I think it's even more important to be able to be open-minded and think about and acknowledge the vast, multifaceted place that China is.
Love it, Eric. Well, thank you so much. One thing we haven't been able to get out of you is your stock pick that you're going to be pitching at the Sohn Hearts and Minds in about a week. But anyone listening can head to the Sohn Hearts and Minds website to buy tickets to see you and many of the other great speakers that will be there at the conference pitching their stock ideas, their best ideas for the next 12 months. A task that is certainly one we've always thought is a very difficult one to do, but one that I think, there's always some great ideas in there. But thank you so much for taking the time
Thank
to
you.
join us from New York. We
Thank
really
you
do
for having
appreciate
me.
it, Eric.
Looking forward to Hearts and Minds.
Thanks, Eric.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.